Imagine stepping back in time just over a decade ago, maybe to 2012.
Okay.
You've just opened an annual letter from an investment firm, and what really hits you is just how surprisingly relevant its insights feel for navigating today's complex financial world.
It's truly fascinating, isn't it? How some fundamental principles of investing and the challenges we face, they seem to remain constant, even when the market landscape feels completely different.
Absolutely. And that timeless wisdom is precisely what we're digging into today. This deep dive is built entirely around the second annual letter to investors from Fundsmith, LLP.
Right, the one covering their first full year of operations, 2011.
Exactly. And it's just a gold mine of insights into their performance, their unique investment philosophy, and some really candid views on big topics like exchange-traded funds and currency hedging.
Yeah, refreshingly candid. Our material today comes straight from that original letter, the 2011.pdf, and it's packed with concrete financial data, actual performance figures, and very detailed explanations of their decisions and market perspectives from back then.
So our mission today is pretty clear. We want to extract the most important nuggets of knowledge and maybe some surprising facts from this detailed document.
Mhm.
We want to help you understand not just what happened, but more importantly, why it still really matters for anyone trying to, navigate investing today. Let's peel back the layers.
Okay.
So Fundsmith officially opened its doors November 1st, 2010. This letter, it's dated January 11th, 2012, and it reports on their first full year, which is dated October 31st, 2011.
And what a year that was to launch a fund.
Right. The letter points out that 2011 was when it gradually dawned on many people that the financial crisis of 2008-09 hadn't really been solved, but had rather been transformed into a sovereign debt crisis. Yeah, I remember that feeling.
Exactly. The big question looming was, who would save the governments? That's a pretty
Right.
intense environment to start a new investment firm. It truly was.
Yeah.
A very, very difficult backdrop. And what's remarkable is how Fundsmith navigated it.
So how did they do?
Well, despite all that turmoil, the Fundsmith Equity Fund actually rose by 8.4% net of fees for the year.
Wow, 8.4% positive in that market.
Yeah. And to put that in perspective, its most relevant comparator, the MSCI World Index, was down a significant 4.5% in sterling terms.
So that's, hang on, a massive outperformance. 12.9% for the year.
Precisely.
That-
And just for more context on how tough things were, the FTSE 100 was down 1.5%, and the MSCI EE, that fell even further by 11.2%.
Okay, so against a sea of red, they delivered a very solid positive return. What do those numbers really tell us, though, especially for someone listening today?
Well, it's not just about winning, it's about how they won. This performance is a powerful illustration. It shows how a clearly defined, disciplined investment philosophy,
Focused on quality companies.
exactly, focused on high-quality companies, can not only survive, but actually thrive, even when the broader market is, well, in disarray. It really highlights the resilience you get from investing in fundamentals, not just chasing market sentiment.
And it wasn't just a fluke, was it?
No, not at all. In the IMA global growth sector, where Fundsmith is classified, only 6 other funds managed a positive return in 2011.
Only 6 others. Out of how many?
The letter doesn't specify the total, but it implies it was a very small fraction. And this performance propelled them to 3rd place in the Morningstar rankings for global equity funds at the time.
3rd place. So the strategy wasn't just performing well in isolation, it was genuinely standing out.
Significantly so.
Okay, let's move inside the portfolio then. Let's explore what drove those returns and maybe what held them back a bit.
Sure. The letter highlights the main positive contributors. Names like Domino's Pizza, Philip Morris, Imperial Tobacco, Colgate-Palmolive, and Unilever.
All very familiar consumer-focused brands. Everyday items, mostly.
Pretty much. On the flip side, the main detractors were Serco, Stryker, Cone, Becton Dickinson, and Intercontinental Hotels.
Okay.
But what's particularly insightful is their commentary on portfolio turnover. They stated their turnover in 2011 was 15%.
15%, which, as they say, is higher than their ideal.
Right, their ideal is closer to 0. But it was still significantly lower than most active funds at the time.
Okay, 15% isn't crazy high, but it's not 0. I'm curious about the breakdown. They explain that, right?
They do. They explain that a portion of that turnover was, quote, involuntary, driven by corporate actions.
Like what?
For instance, they sold Del Monte Food before a cash bid from KKR closed, and they sold Clorox after a bid approach from Carl Icahn.
Ah, the I can bid for Clorox. I remember that.
Yeah, they correctly anticipated that the ICA bid wouldn't actually result in a takeover, but
Yeah.
it did push the share price up temporarily to a point where they felt it no longer offered good value.
So they were kind of forced sellers, in a way, because of external events.
Exactly. And if you strip out those involuntary deals, their actual voluntary turnover was just 4%.
4%. Now that's much closer to their ideal of zero. Incredible discipline.
It is. And they only made 2 actual voluntary sales all year. Kimberly-Clark Corporation, and interestingly, that big winner, Domino's Pizza, Inc.
Okay, let's unpack those. Why Kimberly-Clark?
Well, the Kimberly-Clark case is very telling of their approach. They sold it because it started showing, quote, adverse results from their regular calculation of incremental return on capital.
So based on their own internal metrics, not just market noise.
Precisely. They sold it for a small profit. And what's fascinating is that its fundamental performance did subsequently deteriorate, just as their analysis suggested, even though the share price held firm for a while longer.
Ah, and that perfectly illustrates their philosophy, right? They state, we prefer to judge our investments by what is happening in their financial statements than by the share price.
Exactly. It's a critical distinction for any long-term investor.
Definitely. Okay, so what about Domino's? It was a huge winner, up 113% that year. Why on earth sell a stock that's performing that well?
That's the million-dollar question, isn't it? They concluded it had simply reached a point where it, quote, no longer represented good value. The price had run up so much.
Pure valuation discipline.
Mostly. But there was another factor. There's a significant debt refinancing looming for Domino's by 2014.
Okay.
And while they had no concerns about Domino's own performance, they did have concerns about the broader banking system's ability to actually provide that refinancing in the post-crisis environment.
Ah, so it's a macro overlay on a specific company situation, looking beyond just the company itself.
Exactly. It's a perfect example of how they think holistically. In fact, they even express a hope in the letter to have the opportunity to become investors in Domino's again sometime in the future.
That speaks volumes, doesn't it? Valuing the business quality and valuation discipline over just riding momentum. What about the broader financial metrics and the philosophy they highlight?
Well, they mentioned their total expense ratio, the TER. It was 1.2% in 2011, and they state an aspiration to reduce it further.
1.2%. Yeah.
And their historic dividend yield at year-end was 2.4%, covered 2.6 times by earnings. Only one stock in the entire portfolio didn't pay a dividend at that time.
And they make a point about dividends being more important going forward.
They do. The letter argues that dividends are likely to provide a more significant portion of the total return on equities in the future compared to the big bull markets we saw from, say, 82 to 2000 and 2003 to 07.
Interesting perspective for 2011. And then there's their whole section on share buybacks. They really went deep on this, didn't they?
Oh, absolutely. They had actually
Oh,
published
wow.
research on them earlier that year called Share Buybacks Friend or Foe.
Right. And their conclusions were pretty critical.
Very. They basically concluded that buybacks were rarely accompanied by, proper reasoned justification, often just regarded as good, irrespective of price, which they state bluntly simply cannot be true and were often poorly timed.
That's a strong stance against a very common corporate practice.
It is. And what's particularly striking is how proactive they were. They actually wrote to companies in their portfolio that engaged in buybacks, asking for a clear rationale.
They did what? They actually wrote letters.
Yep. And they noted that responses ranged from prompt, personalized by the CEO, and well-reasoned to being completely ignored.
That's telling. What does that reveal about their focus?
It reveals their focus on what they call reinvestment risk, basically how management uses the cash the business generates, whether it's dividends, investing back in the business organically, or acquisitions, that significantly impact your future returns as an investor.
And they don't pull any punches about the incentives involved either, do they?
Not at all. They critically point out that investment bankers advising companies often get paid fees for arranging buybacks.
But nothing for advising on dividends.
Exactly. Which, they suggest, can naturally slant the advice companies receive. It's a sharp reminder for investors to always consider where the financial incentives really lie.
A very important point. So, looking at the portfolio snapshot at the end of 2011.
Right. It comprised 24 stocks. And get this.
Yeah.
On average, the companies they owned were founded way back in 1894.
1894.
Yeah. The letter proudly emphasizes that these businesses have demonstrated great resilience over a long period of time, surviving 2 world wars and the Great Depression.
That really speaks volumes about their focus on durability, doesn't it? Truly long-lasting businesses.
Absolutely. And their free cash flow, or FCF yield, tells an interesting story too.
How so?
Well, the trailing FCF yield was about 7% at the start of 2011, but it dropped to about 5.8% by the end of the year.
Why is it drop?
Mainly due to rising share prices. Remember, the fund was up 8.4%, plus some portfolio changes, and also higher capital expenditure or working capital needs by some of their companies.
And how did that 5.8% compare to the broader market?
It was actually pretty close to the median FCF yield on the S&P 500 at the time, which is around 6.1%.
Okay, so similar FCF yield to the market, but they offer sharp warning about comparing FCFs, right?
They do, a very sharp warning. They highlight that comparing FCF for banks, they use Bank of America as an example, which apparently had a 76% FCF yield because it added back provisions for bad debts. Comparing that to non-banking businesses is like, well, they're worse. Comparing apples and ugly fruit.
Ah, apples and ugly fruit. That's a great analogy. Really emphasizes the danger of simplistic comparisons across different sectors.
It really does.
Oh.
So even though their portfolio's FCF yield ended up being roughly the same as the market average,
They still firmly believe the quality of their holdings is way above average.
precisely, they argue it's, quote, inconceivable, that it is not of higher than average quality in terms of longevity, resilience, predictability, gross margins, operating margins, return on operating capital, and the conversion of profits into cash.
Right.
Simply put, they believe they own higher quality businesses at a valuation that's about the same as the average for the market.
Getting top-tier assets without paying a crazy premium.
That's the goal.
This detailed look at how they build and manage the portfolio, it just reveals such a disciplined approach, focused on long-term value, that intrinsic quality, robust cash generation. It really offers a compelling blueprint for how you might evaluate your own investments.
Absolutely.
Okay, now let's get to what the letter famously, or maybe infamously, calls the ETF rant.
Yes, the rant.
This was apparently an update on a strong opinion they expressed the previous year about the perils of exchange-traded funds, and it generated, quote, a fury of reaction from the ETF sector. That tells you they hit a nerve.
They certainly did. And the author, Terry Smith, dedicates a fair bit of space in this letter to strongly refute claims that his criticism was just self-serving.
How does he counter that?
He points out Fundsmith's tiny market share at the time. More importantly, he emphasizes his long-held public stance that, for most people, the best equity investment most of the time is an index fund because of its low cost and outperformance of most active fund managers.
Okay, so he's actually pro-index fund investing, generally speaking. That's crucial context.
It is. His beef isn't with indexing itself, it's with certain types of ETFs and how they're structured and sold.
So, if he's not against basic index funds, what are his specific criticisms of ETFs then? He breaks them down, right? Starting with mis-selling.
Yes. He argues many investors mistakenly believe all ETFs are simple index funds, but many just aren't.
How so?
He highlights synthetic ETFs, for example. They don't actually hold the underlying stocks. They use derivatives, swaps, to track the index.
Ah, okay. Counterparty risk there.
Exactly. Then there are inverse ETFs, which can lose you money even if the market they track goes down due to compounding effects, and leverage long ETFs that can lose money even when their market goes up.
Right. The daily resetting mechanism can mess things up over time.
Precisely. These complex structures, he argues, are just not consistent with the simple idea of owning the index.
That's a really significant distinction. And his second concern is specifically about those synthetic ETFs.
Yeah, he really hammers this point. He argues that if a fund description includes terms like synthetic, derivative, swap, and counterparty, and that doesn't raise obvious concerns for an investor.
Then maybe they haven't learned the lessons of 2008-09.
That's exactly his point. It's a stark warning about hidden complexity and counterparty risk, the very things that blew up so spectacularly during the credit crisis.
Makes sense. And his third point, the dangers of short selling within the ETF structure itself.
Right. Because ETFs are traded on exchanges like stocks, short interest people betting against the ETF can sometimes reach, he claims, 10 times the size of the underlying ETF's actual assets.
10 times? How does that work?
It implies that only about 10% of the ETF units people think they hold might be represented by the actual underlying assets the fund is supposed to own. The rest is effectively an IOU, a promise from short sellers to deliver those assets later.
Okay, so what's the risk there?
He warns this poses a significant risk if those short sellers suddenly find it difficult, or maybe impossible, to buy enough of the underlying securities to cover their positions, especially if it's an ETF tracking an illiquid index or sector.
A potential short squeeze dynamic, but within the ETF itself, that could get messy.
Very messy. It reveals a hidden layer of market mechanics that can introduce unexpected volatility and risk, especially in stressed market conditions.
What's really compelling here, though, is the regulatory attention that came after his initial warnings.
Yeah, that's striking. His concerns were later echoed by major financial authorities. The Bank of England, the UK's Financial Services Authority, the IMF, even the US SEC.
So the regulators eventually agreed there were potential issues.
Saying so, he wryly notes this as a rare example of closing the door on a stable which may still contain a horse, meaning the warning came, and maybe some action was taken before a full-blown crisis involving these structures happened.
A good line. And then there's this intriguing profit paradox he mentions.
Right, ETFs are aggressively marketed as low cost, right?
Yeah, that's their main selling point usually.
Yet Fundsmith's research, according to the letter, showed they were amongst the largest profit generators for some banks. How does that work? How can a low-cost product be a major profit center?
It sounds like a contradiction. What's the explanation?
The letter points squarely at synthetic ETFs again. It explains that these structures provide banks innumerable ways to clip the ticket.
Clip the ticket, meaning take little bits of profit here and there.
Exactly. Through various fees. Dealing spreads, swap agreement fees, fees for leverage, prime brokerage fees, custodian fees, registrar fees. It all adds up.
So the headline low cost might hide a multitude of smaller, less obvious costs and profit streams for the providers.
That's the argument. It sheds a lot of light on how something seemingly cheap on the surface can actually generate significant hidden profits for the financial institutions involved.
So his advice is pretty blunt then.
Very clear and direct. If you want broadly based index exposure, just buy a straightforward index fund, not an ETF.
Because the main difference is just that ETFs are exchange traded.
That's what he boils it down to. And his experience and research consistently show that frequent dealing is the enemy of a good investment performance.
So the tradability of ETFs might encourage bad investor behavior.
That's the implication. He then provocatively asks, why would you need to trade intraday? Why buy an ETF rather than a standard index fund where you can usually deal daily anyway? Unless you are, and this is a direct quote, again, hedge funds, high-frequency traders, algorithmic traders, and idiots. These terms are not mutually exclusive.
Wow, okay. He doesn't mince words there.
Not at all. It's a very pointed challenge. But this whole section, I think, offers crucial distinctions between investment products that can look similar on the surface. It really arms you, the listener, with knowledge to make more informed choices and maybe avoid some potential pitfalls.
Definitely food for thought. Okay, let's shift gears now to the currency conundrum. This is another area where Fundsmith seems to challenge common assumptions, this time about global investing.
Yes. So in 2011, they launched new fund offerings, a euro-denominated SICAV.
Which is like a European mutual fund structure.
Basically, yes.
Yeah.
An open-ended investment company based in Luxembourg, acting as a feeder into their main equity fund. And they also launched a USD-denominated USLLP, a limited liability partnership in Delaware, running the same strategy but not as a feeder.
Why launch these new versions?
The letter says it was purely in response to clear investor demand. Specifically, it addressed a massive tax disadvantage for U.S.-based investors trying to invest in U.K. funds.
Tax reasons. Makes sense.
And also catering to offshore investors who just preferred a non-UK vehicle. But here's the key thing. When asked whether these new currency versions or the main fund hedge currencies, their answer is a very firm no.
No hedging. Why not? Isn't that risky for international investors?
Well, they explain exactly why they think hedging is often misguided, or at least much more complex than it seems. First, hedging based simply on the currency of a company's listing country often doesn't make sense.
Why not?
Because there might be very little connection between where a company is listed or headquartered and where it actually operates and earns its revenue.
Right, like their Nestle example.
Exactly.
Not
Nestle,
good.
headquartered in Switzerland, reports in Swiss francs, but only about 2% of its revenues are actually in Switzerland. So hedging Swiss francs forward against, say, sterling would surely not be a hedge at all, as they put it. It wouldn't accurately reflect the real underlying currency exposures of Nestle's global business.
Okay, that makes sense. What about hedging based on where the companies actually earn their revenues? That sounds more logical.
It sounds logical, but they argue it's even more problematic in practice. Many of the companies they own sell relatively low-value items and tend to manufacture and sell locally or regionally.
Like Unilever or Colgate.
Precisely. So the actual currency exposure often relates only to the profit margin earned in different regions, not the full revenue figure. Translating foreign profits back to the reporting currency is the main exposure.
Ah, okay. That's a subtle but important point.
And furthermore, the company's own corporate treasurer might have already hedged some of those currency exposures at the company level.
So if the fund then adds its own hedge on top,
They could inadvertently be canceling out the company's hedge, or even doubling up and creating an exposure where none existed, or making it worse. It's a level of complexity that simple fund-level hedging often ignores.
wow, okay. Hedging is definitely not as simple as it sounds. They even have this concept they call the money illusion thought experiment, right?
Yes,
Yeah.
it's quite clever. They point out that simply denominating these new funds in euros or US dollars doesn't magically change the underlying currency risks. Those risks are driven by the actual investments the global companies they own.
It's just the label on the tin,
Pretty
essentially.
much. They even joked about creating a hypothetical money illusion class of the fund. It would be denominated each year in whatever the world's worst performing currency was.
Like the Turkish lira in 2011, which I think they mentioned was up 32% against sterling, but massively devalued overall.
Exactly. So your statement might look great in lira terms, showing a huge gain. But when you actually cash out, you'd receive that heavily depreciated currency, leaving you no wealthier in real terms in your home currency.
It's a brilliant, almost humorous way to illustrate a very serious point about real purchasing power versus nominal returns.
It certainly is. This whole segment really debunks a lot of common misunderstandings about currency risk in global portfolios. It offers a much more sophisticated perspective on why simple, blanket hedging isn't always the straightforward solution people assume it is.
Definitely makes you think twice about demanding currency hedging. So, as they wrapped up the letter and looked ahead to 2012, what was the tone? Optimistic? Pessimistic?
The letter definitely conveys, quote, some trepidation for the year ahead.
Trepidation, why?
Well, a core belief stated in the letter is that you cannot borrow and spend your way out of a crisis caused by over-leverage.
Referring back to the sovereign debt crisis.
Exactly. And they argue there's no higher authority, no global government that can step in and provide a painless solution, or even just a temporary respite to governments whose creditworthiness is seriously in doubt.
So, the chickens would eventually have to come home to roost.
That's the sense. The dawning of this reality, they predict, is expected to have very painful consequences. It's a pretty stark forecast for 2012.
It is. So, against that rather grim economic outlook, what's their strategic response? Where do they see safety?
Well, they offer a fascinating contrast. They highlight that the credit default swaps, or CDSs, on Nestle, one of their portfolio companies.
And just remind us, CDSs are basically insurance against default.
Right, insurance against a bond issuer defaulting on its debt. They point out that the cost of insuring against Nestle defaulting was actually less expensive for some time than insuring against default on some European government's debt, and even U.S. Treasury debt.
Wow. The market thought Nestle was safer than some major countries.
That's what the CDS market was implying, yes. Which is a powerful statement about Nestle's perceived financial strength and stability compared to sovereign nations at that moment.
So what does that suggest about where Fundsmith sees relative safety in uncertain times?
It strongly suggests their view that holding shares in major conservatively financed companies, which make their profits from a large number of small, everyday, predictable events, is a relatively safe place to be.
If. There's always an if, isn't there?
If one has the patience, fortitude, and liquidity to ride out the share price volatility, volatility is unavoidable, even in quality companies.
Patience, fortitude, and liquidity. The holy trinity for long-term investors, maybe?
Could be. And the letter concludes by stating this strategy holding resilient, predictable, conservatively financed global companies is exactly where and how our fund is invested.
So it's a clear investment philosophy designed specifically for navigating economic uncertainty, emphasizing that resilience and predictability over trying to make speculative macro bets.
Precisely. It really boils down to finding fundamental strength in what might be a very volatile world.
It does. You know, this deep dive into a letter from over a decade ago, it really reveals that some of the most critical questions in investing, they just don't change much, do they?
They really don't.
Questions like, what truly constitutes a quality business? What are the hidden complexities and risks in popular financial products? These things are timeless.
Absolutely. The context changes, the products might evolve, but the underlying principles often remain the same.
So as you, our listener, consider your own financial journey, maybe think about this. What singular principle from this deep dive really resonates? What will you prioritize? Perhaps it's that relentless focus on resilient cash-generating businesses.
Or maybe it's developing a more critical eye towards things that are marketed aggressively as simple or low cost, like some ETFs were back then.
Something to mull over. It shows how studying investment history, even relatively recent history like this, can offer valuable lessons for today.